So picture this. You walk into a bank, or maybe you're just sitting at your kitchen table filling out some online form, and they ask you that question. The one that feels so routine, so normal, that most people just answer it without thinking twice. What is your annual income? And you type in your number. Maybe you're a little proud of it, maybe a little embarrassed, maybe somewhere in the middle. But you type it in, you hit submit, and you move on with your day, completely unaware that you just handed the bank something far more valuable than you realized. Not just a number, a profile, a risk score, a marketing target, a ceiling. I've been fascinated by this exact moment for years. That one little question, what's your income, and the way people answer it so automatically, so trustingly, without ever stopping to ask, why does the bank actually need this, and what are they doing with it once I tell them? My name is Emmy, and I spend probably an embarrassing amount of time thinking about money, specifically about the gap between what banks tell you they're doing and what they're actually doing. About the systems that were built ostensibly to help you, but were quietly optimized to serve the institution first. And the more I've dug into this, the more I've come to believe that most people are walking into their banking relationships with a kind of trusting naivety that ends up costing them in ways that are hard to see, but very, very real. Here's what I want to leave you with by the end of this video: a completely different way of thinking about your relationship with banks. Not paranoid, not conspiratorial, just informed. Because once you understand why banks want your income information and what they actually do with it, you will never fill out one of those forms the same way again. And honestly, that shift in awareness might be one of the most financially valuable things you pick up this year. Let's get into it. The myth of the routine question. There's a concept in behavioral economics called choice architecture, the idea that the way options are presented to you quietly shapes the decisions you make, often without you realizing it. Banks are, whether they'd admit it or not, absolute masters of choice architecture. When a bank asks for your income, it doesn't feel like a significant moment. It's sandwiched between questions about your address and your social security number. It's presented as administrative, required, boring even. And that blandness is by design, because if the question felt significant, you might actually stop and think about it. But here's the thing, it is significant, profoundly so. The income figure you provide doesn't just live in a database somewhere, inert and harmless. It gets processed, cross-referenced, and used to make decisions about you. Decisions that affect what products you're offered, what credit limits you receive, what interest rates you qualify for, and frankly, how much the bank expects to be able to earn from your relationship over time. That last part is worth sitting with. Banks think about lifetime customer value. They're not just thinking about the checking account you're opening today. They're running calculations, sophisticated ones, about how much money they can make from you over the next 10, 20, 30 years. And your income? That's one of the primary inputs into that calculation. Okay, so let's be precise here, because I don't want this to feel like a vague, the system is rigged rant. I want to be specific, because the specifics are what actually matter. When you disclose your income to a bank, here are the primary ways that information gets used. First, credit underwriting. This one is the most obvious and the most legitimate. When you apply for a loan or a credit card, the bank needs to assess whether you can repay what you borrow. Your income is a key part of that assessment. Totally reasonable. No argument there. Second, product targeting. Here's where it starts to get interesting. Once the bank knows your income bracket, it can slot you into a customer segment, and different segments get marketed very different things. Someone who reports a $45,000 annual income will see different offers, different promotions, and different upsells than someone who reports $200,000. This isn't just about credit eligibility, it's about which products the bank thinks it can sell you and at what margins. Think about this. High-fee financial products are disproportionately marketed to people in certain income brackets, not because those products are better for them, often they're worse, but because the bank has determined that this segment is more likely to buy and less likely to compare shop. Third, relationship pricing. This is a quieter one, but it matters. Some banks use income data to determine whether you're worth courting with better rates, reduced fees, or premium service. If your income signals that you're a high-value customer, you may actually be offered better terms. Not automatically, but you'll be more likely to get them if you ask. Conversely, if your disclosed income puts you in a lower value segment, the bank may not extend those concessions as readily. Fourth, data monetization. This is where a lot of people's eyes widen. Banks are increasingly in the business of data. Aggregated, anonymized income data is extraordinarily valuable to advertisers, market researchers, insurance companies, and third-party financial services providers. When you sign those thick disclosures, the ones nobody actually reads, you're often consenting to your data being shared in ways that are technically disclosed, but practically invisible. Now, I'm not saying this to terrify you. I'm saying it because informed people make better decisions, and right now, most people are making this decision completely blind. The income ceiling nobody talks about. Here's a concept that genuinely changed the way I think about this, and I want to explain it carefully because it's subtle. When you tell a bank your income, you are in a very real sense setting a ceiling on how that bank perceives your financial potential. Let me give you an example. Say you earn $80,000 a year as a salaried employee. You disclose that. The bank now has a mental model of you. You're an $80,000 a year person, and everything that follows, the credit limit they assign you, the mortgage amount they're willing to underwrite, the investment minimums they put in front of you, is calibrated to that number. But here's the thing. That number doesn't capture that you have $200,000 in home equity. It doesn't capture that you have a side business generating $30,000 a year in revenue that's growing fast. It doesn't capture that you have a spouse with income, or significant assets, or a trust, or a stock portfolio. Your income is one data point, but the bank treats it like the whole story. And this creates a weird, quietly damaging dynamic where people are essentially trapped by the number they volunteered. I've talked to people who have been banking at the same institution for 15, 20 years. Their financial picture has grown enormously, but because they've never renegotiated how the bank perceives them, because they keep updating their income figure on forms and letting the system re-slot them, they're still being treated roughly the same way they were a decade ago. The bank isn't going to rethink you on its own. You have to rethink how you present yourself to the bank. The privacy layer most people ignore. Let's talk about something that's less about strategy and more about basic rights that most people don't realize they have. In the United States, the Gramm-Leach-Bliley Act, and yes, I know that sounds like the kind of thing only a compliance nerd would bring up, actually gives consumers certain rights around how financial institutions share their personal information. You have the right, in many cases, to opt out of having your information shared with non-affiliated third parties. Most people have never exercised this right. Most people don't even know it exists. Every year, banks are required to send privacy notices, those emails or paper inserts that look like junk mail and get immediately discarded. Those notices actually contain opt-out instructions, and when you ignore them, you're implicitly consenting to broader data sharing. Now, opting out won't protect you from everything. There are exceptions. For example, banks can still share your data with certain affiliates and for certain purposes, even if you opt out. But exercising your opt-out rights is meaningfully better than not doing so, and it's something almost nobody does. Here's the small, practical action. Go to your bank's privacy policy page, usually buried in the footer of their website, find the opt-out form, and fill it out. It takes maybe 10 minutes. Most people never do this. Do it anyway. Why wealthy people handle this differently. I want to spend some time here because this is one of those things where the gap between how ordinary people engage with financial institutions and genuinely wealthy people is just stark. Wealthy people, and I'm talking about people with real multi-generational wealth, not just high earners, approach banks very differently. They don't think of banks as institutions to trust, they think of banks as service providers to negotiate with. When a high net worth individual engages with a private bank or a wealth management division, they're not filling out a form and waiting to see what the system spits out. They're sitting across from a relationship manager and they're presenting their financial picture selectively and strategically. They're sharing what helps them and declining to share what doesn't. They're negotiating rates, minimums, and terms before they ever formally apply for anything. This is not how most people think about their banking relationships. Most people think of the bank as the authority, the entity with the power to approve or deny, and they approach that interaction with something close to supplication. They provide everything asked of them, answer every question, fill in every blank, because they're afraid that withholding anything will hurt their application. And the banks love this dynamic. They cultivate it. The architecture of the application process is specifically designed to make you feel like the supplicant and the bank like the authority. But here's the reality. If you have decent income and assets and credit history, the bank wants your business. You have leverage. Most people just never exercise it. What you don't have to disclose and when. Okay, let me be careful here because I don't want to give anyone advice that gets them into trouble, and I'm definitely not a lawyer. But there are some important distinctions worth understanding. When you're applying for credit, a loan, a mortgage, a credit card, the bank does legitimately need income information, and misrepresenting your income on a credit application is not just unwise, it's potentially fraudulent. So we're not talking about lying, ever. Clear? But there's a difference between a formal credit application and other banking interactions. When you're opening a basic checking or savings account, when you're inquiring about products, when you're in early conversations with a banker about what might suit your needs, in many of those contexts, providing detailed income information is optional, and you often don't realize that because the form makes it feel mandatory. You can decline to answer. You can say, "I'd prefer not to provide that at this stage." You can ask what the information is used for before you provide it. These are all legitimate responses that most people never think to give because the process is designed to make you feel like non-disclosure is not an option. It almost always is. And even in contexts where you do need to provide income information, like a credit application, there are things worth knowing. Income, as banks define it, can include more than just your W-2 salary. It can include rental income, investment income, business income, alimony, Social Security, and more. Many people underdisclose their income by defaulting to just their base salary when they have legitimate additional income sources they could include. This isn't manipulation, it's knowing the rules of the game. The relationship between income disclosure and credit limits. Here's something that genuinely surprised me when I first started digging into this. Credit card companies and banks don't just use your income to approve you, they use it to set your initial credit limit. And that initial credit limit has an outsized effect on your credit utilization ratio, which, as you probably know, is a major component of your credit score. So the number you report as your income doesn't just determine whether you get approved, it determines the ceiling of your credit limit, which affects your utilization ratio, which affects your credit score, which affects the rates you'll pay on future credit, which affects your long-term cost of borrowing. One number, cascading consequences. Most people have no idea. Now here's the thing that really matters. Credit card issuers in the U.S. under the Credit Card Act of 2009 are actually required to consider your ability to pay, but they're also permitted to ask for household income, not just your individual salary. This means that if you're in a household with two incomes, you may legitimately be able to report the combined household income on applications, not just your personal salary. For many people, especially those in dual-income households, this is a significantly higher number and could result in meaningfully higher credit limits. Again, not gaming the system, just understanding what the system actually allows. The data broker ecosystem most people don't know about. Let me pull back the curtain a little further because I think this is genuinely underappreciated. There is a massive data broker ecosystem, companies whose entire business model is aggregating, packaging, and selling consumer data. And financial data, including income information, flows into this ecosystem through channels that most consumers would be shocked to know about. Some of this is through the banks directly, through the data sharing practices disclosed, technically, in those privacy notices nobody reads. Some of it is through credit bureaus, Equifax, Experian, TransUnion, which maintain detailed financial profiles on virtually every American adult and sell access to that data to thousands of entities. Some of it is through fintech apps that people enthusiastically grant access to in exchange for some feature that lets them see all their accounts in one place. This last one is worth dwelling on. Budgeting apps, income tracking apps, financial planning tools, many of these are genuinely useful, but they also aggregate extraordinarily detailed pictures of your financial life, your income, your spending patterns, your debt levels, your saving behavior. And the business model of many of these apps is not subscription fees, it's data. When you link your bank accounts to a third-party app, you are often providing more comprehensive financial data than you'd give to the bank itself. And that data doesn't just sit there. It gets analyzed, anonymized to varying degrees, and monetized. I'm not saying stop using these tools. I use some of them myself, and they can genuinely be helpful. But go in with eyes open. Understand what you're trading for the convenience.
All right, so we've covered a lot of ground. We've talked about why banks want your income, what they do with it, and some of the downstream consequences you probably weren't fully aware of. Now I want to spend a few minutes talking about the bigger shift, the mindset shift that I think makes all of this actionable. The framing I want to offer you is this. Your relationship with a bank is a business relationship between two parties with competing interests, not a service relationship where the bank is on your side. This doesn't mean banks are evil. It means they're businesses with shareholders and profit objectives. And the products they offer are priced to be profitable for the bank first. That's not a scandal, that's capitalism. But it means you need to show up to that relationship as a counterparty, not a supplicant. What does that look like practically? It looks like asking questions before you answer them. Why do you need this information? What will you use it for? Who might it be shared with? These are reasonable questions. A good banker should be able to answer them. It looks like understanding what you're consenting to before you sign anything, not just the headline terms, the actual fine print about data usage, sharing, and your opt-out rights. It looks like periodically reviewing your banking relationships, the rates you're getting, the fees you're paying, the products you're using, and being willing to negotiate or walk away. Banks give better deals to customers who ask. It's almost embarrassingly consistent. It looks like being strategic about what you share and when, especially early in a relationship before you've established leverage. And it looks like recognizing that your financial information, your income, your spending patterns, your assets, is valuable and treating it with the same care you'd give to any other valuable asset. The specific moves worth making. I want to get concrete for a second because I know it can be easy to listen to something like this and nod along and then not change anything. So let me give you a short list of things that are actually worth doing. Find your bank's privacy opt-out form. Go to their website right now, seriously, after this video, search privacy opt-out or look in the footer for privacy policy. Fill out the form. This limits what they can share with non-affiliated third parties. It takes 10 minutes. Most people never do it. When you're in an exploratory banking conversation, not a formal application, just a let me learn about my options conversation, be comfortable saying, I'd like to understand what products are available before I provide detailed personal information. This is completely reasonable. Most bankers will respect it. If you're in a dual income household, understand that many credit applications allow you to report household income, not just your individual income. This is legitimate and could meaningfully improve your credit positioning. If you've been at your bank for more than a couple of years, call them, not to complain, just to ask, "I've been a customer for X years. I'd like to understand what rate or fee adjustments might be available to me." Banks have retention programs, they have fee waiver capabilities, they have rate negotiation authority. You just have to ask. And finally, periodically audit what third-party apps have access to your financial accounts. Most banks now have a section in their security settings that shows you which third-party apps are connected. Go look at it. Revoke access to anything you're not actively using. These aren't radical moves. They're not going to transform your financial life overnight, but they're real and they matter. And they're things that financially sophisticated people do quietly while most people never think about them. Conclusion: the awareness advantage. We're getting close to the end, and I want to take a moment to bring this all back together. Not just the tactical stuff, but the bigger idea. Most people go through their financial lives in a kind of pleasant fog. They trust the institutions they deal with in the way you might trust a contractor you hired, assuming that because you're the customer, your interests are being looked after. And up to a point, that trust isn't misplaced. Banks do provide real, valuable services. Most bankers are not sitting around scheming against their customers. But there's a gap, sometimes a significant one, between what's good for you and what's optimized for the institution. And that gap gets navigated in your favor or theirs, depending entirely on how aware and engaged you are. The moment you realize that your income disclosure is not just an administrative step, but a piece of information with real consequences for how you're segmented, targeted, limited, and monetized, is the moment you start showing up to those interactions differently. Not defensively, not paranoid, just awake. And honestly, the people who navigate financial institutions most effectively aren't the ones who found some secret loophole or who refuse to engage with the system. They're the ones who understand the system well enough to participate in it strategically. They ask questions, they read things, they exercise rights they actually have. They treat their financial information as the valuable commodity it is. That's not an elite club you need special credentials to join. It's just a decision to pay attention. So the next time a bank or any financial institution asks you for your income, I'd encourage you to pause for just a moment before you answer. Ask yourself, do I need to provide this right now? Is this a formal application where it's required, or is this an exploratory conversation where it's optional? What will they use this for? Do I understand what I'm consenting to? Most of the time, you'll answer the question, but you'll answer it consciously, with your eyes open, and that small shift, that moment of awareness before the automatic response, is what separates people who are managed by financial institutions from people who manage their relationships with them. That's worth something. I genuinely believe that. Thanks for watching. Take care of your money, because the institutions you trust it with are certainly taking care of theirs.